Friends, take a close look at this chart. The market had been moving in a strong uptrend, but as soon as it reached a certain level, it suddenly reversed. Now take a look at this second chart. Here the market was in a solid downtrend, but from one specific area, the price changed direction and started moving upward. So, what happened at these levels that caused the market to completely reverse its trend? What if you could know in advance from which area the price is likely to move down, or from which area it could move up? In today's video, I'm going to show you the top candlestick patterns that can tell you when the market is about to reverse. As soon as these patterns appear on the chart, you'll know that a reversal may be coming, and you can look for a trade entry. Basically, we'll learn these candlestick patterns in two parts. First, I'll explain the candlestick theory, when a candle forms, how it forms, the psychology of buyers and sellers behind it, and what it tells us about the market. After that, we'll move on to real charts and understand with practical examples how these candlestick patterns work in trading and how to use them to take trade entries. Before we continue with the video, if you haven't liked it yet, make sure to hit the like button and subscribe to the channel so you never miss informative videos like this, and you'll be the first to get notified whenever a new video is uploaded. Now let's talk about the hammer candle. The hammer candle is a bullish reversal pattern that usually forms after a downtrend near a support area. It is identified by its small body and a long lower wick. The upper wick is either very small or absent. This long lower wick tells us that sellers tried to push the price lower, but buyers stepped in with strong buying pressure, pulled the price back up, and took control of the market. That's why the hammer candle is considered a sign of a potential reversal. When, after the hammer candle forms, the next candle breaks above the hammer candle's high with a strong body close, it is considered confirmation that buyers have taken control, and we look for a buy entry. Now let's understand this with the help of a chart. As you can see here, the price is moving in a downtrend and approaches a support area. One important thing to notice is that several hammer candles formed during this entire move, but the price did not reverse from those levels. Why? Now look here. A hammer candle formed at this point, indicating that the selling pressure was weakening and the market was starting to show signs of weakness. However, the formation of a hammer candle alone is not enough. After that, a strong bullish candle formed and broke above the hammer candle's high with a body close. This means buyers are now becoming active in the market, and control is gradually shifting from the sellers to the buyers. As you can see on the chart, the price then started moving upward and continued its bullish move. The reason the price did not reverse from the previous hammer candles is that forming the candle alone is not enough. It must also appear at the right location. As you can see, those earlier hammer candles did not form near any significant support level, so the market ignored them and the downtrend continued. However, this hammer candle formed near a major support area. It was followed by a bullish confirmation candle that broke above the hammer candle's high with a body close. After that, the price reversed and began a strong upward move. The second candlestick pattern is the hanging man candlestick pattern, which looks very similar to the hammer candle. The main difference is that it is usually red in color. This candle has a small body, and its lower wick is at least twice the size of the body. This pattern shows that during the session, sellers pushed the price significantly lower. Buyers then tried to bring the price back up, but they failed to break above the candle's high, and the candle still closed red. This indicates that sellers are stronger than buyers at this point. For this reason, the hanging man is considered a potential bearish reversal warning signal. When this candle forms after an uptrend near a resistance zone, and the next bearish candle closes below the hanging man's low with a body close, the market is likely to reverse and move to the downside. Now let's move on to our third candlestick pattern, the bullish engulfing. The word engulfing means to completely cover or swallow. A bullish engulfing is a two-candle pattern. The first candle is bearish, followed by a large bullish candle that completely engulfs the body of the previous bearish candle. This pattern tells us that sellers were initially in control of the market, but buyers suddenly stepped in with such strong buying pressure that they completely engulfed the previous bearish candle and formed a large bullish candle. That's why the bullish engulfing pattern is considered a strong trend reversal signal. Whenever a bullish engulfing pattern forms at a support level, and the next bullish candle breaks above the bullish engulfing candle's high, the market can reverse from that point and begin an upward move. Now let's move on to our fourth candlestick pattern, the bearish engulfing. A bearish engulfing is a two-candle pattern. The first candle is bullish, followed by a large bearish candle that completely engulfs the body of the previous bullish candle. This pattern tells us that buyers were initially in control of the market, but sellers suddenly stepped in with such strong selling pressure that they completely engulfed the previous bullish candle and formed a large bearish candle. That's why the bearish engulfing pattern is considered a strong trend reversal signal. Whenever a bearish engulfing pattern forms at a resistance level, and the next bearish candle breaks below the bearish engulfing candle's low, the market can reverse from that point and begin a downward move. Now let's talk about the Doji candle. Friends, the Doji candlestick represents market indecision. In this candle, the opening price and closing price are almost the same, which is why the candle has a very small or nearly invisible body. A doji tells us that there was a strong battle between buyers and sellers. Either buyers initially pushed the price higher, but sellers brought it back down to close near the opening price, or sellers first pushed the price lower, but buyers later stepped in and pushed it back up to close near the opening price. If a doji forms after a strong downtrend near a support level, it may indicate that sellers are losing strength. On the other hand, if a doji forms near a resistance zone, it may suggest that buyers are becoming weaker. However, assuming a trend reversal based on a doji alone can be a big mistake. This pattern should always be confirmed by the next candle, just as we saw with the hammer and hanging man patterns. In simple words, a doji is a market warning signal that suggests the market may be preparing to change direction. Now let's talk about the sixth candlestick pattern, the morning star. Friends, the morning star is a very popular bullish reversal pattern. It consists of 3 candles. The first candle is a strong bearish candle. The second candle has a small body that represents market indecision, and the third candle is a strong bullish candle. This candlestick pattern usually forms after a downtrend near a support area. It indicates that sellers were initially in control of the market. Then, a strong battle took place between buyers and sellers, and eventually, control of the market gradually shifted into the hands of the buyers. To take an entry using this candlestick pattern, we should first let it form at a proper support area. Then, if a bullish candle breaks above the pattern's high after it is formed, we can plan a buy-side entry. However, you should never take a trade based only on this candlestick pattern. You should also analyze the trading volume, because volume tells us how strong the buyers are behind the move. If you don't know how to analyze volume, I have created a detailed video on this topic, which you can watch by visiting my profile. Now let's move on to our 7th and final candlestick pattern, the evening star. The evening star is a very popular bearish reversal pattern. Like the morning star, it also consists of 3 candles. The first candle is a strong bullish candle. The second candle has a small body that represents market indecision. And the third candle is a strong bearish candle. This candlestick pattern usually forms after an uptrend near a resistance area. It indicates that buyers were initially in control of the market. Then, a strong battle took place between buyers and sellers, and eventually, control of the market gradually shifted into the hands of the sellers. To take an entry using this candlestick pattern, we should first let it form at a proper resistance area. Then, if a bearish candle breaks below the pattern's low after it is formed, we can plan a sell-side entry. However, you should never take a trade based only on this candlestick pattern. You should also analyze the trading volume, because volume tells us how strong the sellers are behind the move.